So it's a pleasure to be with this event again. Trevor, thank you for inviting me once more. I'm very pleased to kick off. As you know, we publish the global data on the industry, including forecasts for the next 5 years, and the publication of that is timed to coincide with this event. So I'm going to run through some of the highlights of that. And I think quite a lot of you have seen the data before, and we all know the US is a very big market and so on. So I'm not going to repeat some of the base data. What I'm going to do today is I'm going to just give a view of some of the changes, pointing to some of the highlights, and look at some of the ways in which we are analyzing the markets, hopefully following some of the important trends. So that'll be the first thing I'll look at. And then after that, I think we're going to look at something which is possibly ambitious, and that is trying to have a look at some of the key performance indicators across the industry, based on data that we have brought together. Quite an ambitious task, and I'm sure there'll be plenty of scope for questions or people to say that doesn't make sense. But we'll try this out, and we'll see if it gets some debate going or creates a little bit of food for thought. So that's how we're going to approach it. Very happy to have heckling. So if people have got burning questions, they can stick their hands up and there's a mic. Or at the end, I think we'll have some time for some Q&A. And of course, I'm around over the 2 days if people have any questions. So let's get going. First of all, I think you all know who we are at AMR. People sometimes get very confused. I've written 5 books on mergers and acquisitions, so people think I'm an author. I'm not. We publish one piece of market data. People think we're a market research company. We're not. We're a strategy firm, 60 people. All the countries in that blue color are ones we've worked with in our feet on the ground. The red blobs are where we've got offices or associates. And we think we're a strategic partner to the exhibition industry, really trying to help with thinking and help people with their strategies. So that's who AMR International is, so no one's confused. So if we move on now, I'm going to start with what we call Globex and just look at some of the highlights of Globex and some of the changes, as I said, from previous editions. And we're looking 5 years forward in the industry. So the good news is that the industry has fundamentally rebounded, which we know from the very dark days. We know that exhibitions can have a slightly different cycle to the general economic cycle, can sometimes be late in and late out. We've got 3 lines here showing our forecast through to 2016. So we have the total line in red, emerging markets in the blue, and mature markets in the green. So we are looking at overall market growth, so knocking on the door of 6% is our forecast for the next 5 years. This is between 0.5 and 0.8% less optimistic than 1 year ago, which I think reflects where we are with the Eurozone crisis and the double-dip recession in some areas, but remains a reasonably healthy outlook overall. But as ever, there is a split between emerging markets and mature markets. And within this, of course, there's going to be a lot of detail on a country-by-country basis. If we move on to this country-by-country basis, here we can see the market growth in 2011, which is obviously the last full year which we have data on. We can see the usual suspects at the top of the pile, although GCC, which is the Gulf region, has come back up the table, partly because of the resurgence of Dubai, but also activity in Saudi Arabia with launches there, for example, and Abu Dhabi. So we see some stronger growth there than we had before. The total growth for the market you can see in red at 3%. And then we've just picked out some exceptions here through show cycling. We can see a number of countries, mostly the European countries, where some of the biennial or triennial effects have made a big difference. So you can see on a like-for-like basis, we put in Germany and Italy, which actually on a single-year basis were more negative. So that gives us a better view. But this shows you the growth of 2011. If we go and look at now our forecast growth, This is so 5 years ahead, country by country. You can see that we have Brazil at the top of the pile. China is in fact coming down a little bit compared to the stronger growth which we had there before. China is obviously increasingly important. Both Reed and UBM have got more than $100 million of revenue in China now. Messe Frankfurt, well represented here, obviously very strong in China as well. The other thing you'll see that we've broken out here for the first time explicitly is the difference between space growth and price growth, and we also have non-stand revenues broken out. So we've taken those three elements to say, well, what is the growth comprised of? Let's just start with the smallest piece on the right-hand side, which is non-stand revenues. I'm going to come to some more detail on that, but the fundamental point is that non-stand revenues are growing faster than anything else, from a smaller base, of course. So there's a strong emphasis on non-stand revenue growth. And then we can see the balance between space growth and price growth. And I think it's just worth making a fundamental observation about the industry. And I will reference a couple of times the white paper we launched at the CISO CEO Summit 6 months ago, which I hopefully has been circulated to everyone, including those who weren't at CISO, fundamentally showing that the industry has got a challenge of dealing with value, because over the decade up to the Great Recession, the exhibition industry was actually giving declining value to its customers, because price had been pushed above inflation, and the number of visitors who were attending events and the time they spent at events was declining. So up to the Great Recession, the analysis we had on the overall industry showed that prices had been pushed above inflation. We are now looking at an industry after the Great Recession which is struggling to keep up with inflationary price rises. Just for example, in China, quite a lot of organizers would say, no, I want more volume, not price. And there are plenty of other examples of price pressure. So we see the Great Recession as a turning point, and that's going to lead into some of the, I think the one fundamental point I want to bring out of the KPI analysis as to how to deal with that. So this gives you a view of the growth by countries. Again, we can see emerging markets with pretty healthy growth rates, and some of the mature markets struggling. Now, I've mentioned the non-stand revenues. So for the first time, we're explicitly breaking out non-stand revenues because they are so important. And we've got, I think, a table at the back where we have a lot of our friends from the United States. I'm sure they would all say, we're not at all surprised to see the US at 30% non-stand revenues. But I think some other people might say, that's a big slug of non-stand revenues in the industry. We know that the US is by far the largest market in the global exhibition organizing industry. What comprises that 30%? Broadly, 20% is admission fees, getting into an event. Some of that is going to be related to consumer events, but also there's a lot of content, conference content-led events in the United States. About 8% sponsorship and 2% digital. So broadly, that's what it's made up of. And of course, when we look at this, there's always a question of the extent to which certain trends are going to move across to different countries. France, quite a lot of public events in there as well. As we move to the right, in the more developing markets, we just don't have that same opportunity for that volume of non-stand revenues. But over time, of course, we're going to expect that to grow, and you would have seen that reflected in the forecast. So if we were to take the global number, it's around 20%. But obviously, we've got very different circumstances in each market. So saying 20% as a target would be naive. So I think that is a focus area of development for organizers in the past, and will continue to be one in the future. Looking at the organizers, there's no major changes in the league table. I'm going to correct Simon. I'm sorry you haven't done your homework and read Globex properly. I think Reed had 4% market share and has gone to 5%, which you could say is a 25% increase in market share. But it's still a very fragmented market, so that's a low market share. But if you take out associations and say, well, can we really play an association market? Well, that would be bigger. But here are the scale of the businesses. No changes in the league table, as Simon also said. Well, maybe we would have expected something to have happened, some people to have merged. Well, that hasn't happened. Maybe in the future, who knows? One thing I would say, which is interesting, a few years ago, we would have looked at this, and the red dots for profitability, there were some very low ones, including a number of the Messen. And those numbers have come up, which is also a reference to some of the change in the Messen and the approach taken by them and some of their improvement in operating performance. The green is emerging markets, and Russell's going to follow me up, and he will no doubt point out that IT is doing extremely well in the green bit, very strong emerging market player. And overall, very healthy profit margins in difficult economic times, which is, I think, a big achievement for the industry. I also just give an update on M&A, but I don't have much to say this year. This is just, again, the historical M&A activity. The blob colour is really the buyer, private equity, all lumped into one bucket, and then some of the major buyers are set out here. A couple of things to notice recently. Informa seem to have been pretty active. They've come back with a number of deals. And private equity, we can see, were paying very high prices and now are paying somewhat lower prices for businesses. So there's been a calming in the multiples. This is just a very brief overview. There are many, many more deals, and a lot of them smaller without published information. So I would say on the M&A landscape, there's been a lot of activity, but nothing particularly significant in the past year. So that's a summary of some of the highlights and the changes of Globex. As I said, I don't want to spend too long on it because I think a lot of the market data is well known to people. I just wanted to bring out a few of those points. Let's now look at some of the measures of the industry, or some KPIs or benchmarks or whatever consulting jargon we want to use, and just think about them. So we thought it would be interesting, having done so many hundreds of projects in the exhibition industry, to bring together some of that data into a database. And that would allow us to explore some of the drivers of success in the industry. But at the same time, it also should be a resource we would hope that will be useful for organisers when they're trying to say, well, how are we doing against others or against sectors or countries or whatever. So to allow some kind of peer review or benchmark approach. Benchmarking is always something which is very difficult because there will always be exceptions, and quite often if people don't like the answer, they then start arguing with the methodology. So it tends to be a directional, and we have to recognize that. And we have about, I think, 4,500 shows in the database, on which we have got different data sets for each one. And that data comes from the data we use for Globex. It's also come from working with well over 20 different organisers, and also we can supplement that with some of the AMR data specifically on sectors. And of course, all the data is aggregated, so no single show or no single organiser is mentioned at any point. The whole thing absolutely needs to stay anonymous. And this will grow, and this will develop, and that will allow sort of finer tuning over time. The measures in here, we can look at profitability of events, so that's at a contribution margin basis, and the average contribution margin across all events is in the sort of 43 to 45% category, depending upon the cuts you take. And then we have churn, we can have performance growth, a whole set of different measures, and I'm just going to show you some of these here and see if any stories come out of those. So let's kick off and have a look at contribution margin by country. So here we've simply taken country cuts of the data, and we're asking the question, well, what is the average contribution margin of events in those countries? We've seen the growth rates of the countries, but what is the overall performance of businesses in events in those countries? An interesting thing here is that we have Western markets in the middle ground, and we have the BRIC or developing economies spread across this range. So there is a massive range here. So we're showing you the outliers as well, and the extent of this range. And some of the drivers of these contribution margins are going to be linked, for example, to venue, so venue quality, venue price. They're going to be linked to whether Western exhibitors want to gain access to new markets and are prepared to pay a premium price. So there's going to be a large number of factors driving these margins. But we can see India tends to be somewhat lower. China tends to be somewhat lower. And we have Russia and Hong Kong at the upper end. When we look at this by sector, we find there are also certain sectors which tend to have higher contribution margins. And themes coming out here would be a high proportion of Western exhibitors keen to enter new markets, and obviously linked to that, very international events versus low-price domestic events. But we can see here again, there is a substantial range in contribution margin by sector. And so some sectors appear to be more attractive than others by margin. Overall, we can see the sector data comes out slightly higher than the country data, meaning that certain sectors actually do appear to be quite attractive. So that sets the scene for margin by country and by sector. Let's just move on to size, show events, show size. Now, I think everyone in this room knows the bigger your event, the more profitable it's likely to be, because exhibitions scale, and that's a part of the beauty of the industry. So we've just taken here as part of the sample, and we've taken up net square meters up to 80,000. Obviously, there are much larger events, but we cut off at 80,000. And we can see that, yeah, it is unsurprising that as shows get bigger, their contribution margin increases. But something which struck me here as being very interesting was that there are a substantial number of smaller events that are above the line. So the big is beautiful mantra, yes, is a good one, but there are also some great events which are smaller. So, I mean, just one example of that would be a 4,000 square meter event in Germany in cosmetics. That has a unique competitive position, that has a low marketing cost, is in an inexpensive venue, and at 4,000 square meters is in a real sweet spot and is one of the outliers. So I think that it shows that you can really achieve some strong margins with smaller events. Obviously, below the line is a less happy story, but some of these are events in their early editions, and so we'd hope that as they grow, their margins would improve. So for me, that was a slightly interesting takeaway, to see the spread and how it's possible to be very successful with some smaller events. Now, as I'm going to move on to the theme of what it is that's going to take to drive success in the future. I think a lot of people will always start with their business and say, well, what's my cost base? And let's get the cost base under control and see where to go from there. So I've just got one cut of looking at the cost base here. And what we've done is we've taken the average cost base of shows in the database, and we've looked at where the money goes. So venue rental is 33%, marketing 13%, sales 6%. Obviously, there are other costs as well. So that's a global picture of the typical breakdown of costs of events. On the right-hand side, we can see some of the extremes. And we can see here venue rental varies from sort of 13 to over 50%. So there are massive variations which make up the 33% average. And I've already referenced some of the venue points, which I'm sure people will be familiar with. And if there is competition in a market, we're going to find pressure on venue prices, or sorry, it'd be easier to obtain a more attractive tenancy. When there is not competition, it'd be a different story. Marketing costs are highly varied, and I think this is something which the industry needs to worry more about in the future, particularly with the theme I'm going to be bringing out about attendees and the need to attract the right attendees. And I think that adage of half of my advertising money is wasted, but I don't know which half really does apply to marketing costs. And I think that at the bottom end, we see some quite inefficient marketing. Sales, again, a massive range, and here we've just given one of the breaks of own sales versus the use of agents. There are cases where the use of agents can be particularly expensive. But this gives us an overall snapshot of the cost base of events. And I think if anyone wants to benchmark their own events, they need to get into the detail and look at real comparables as opposed to the overall blended results, which is really no more than a guide. So that's the cost base. If we then look on to what is it that drives contribution margin, here is a piece of very simple analysis that does not come up with a surprising result of if I have a market-leading show, which is defined as the largest in our market, we simply went through and coded the data, versus a follower, we have a higher contribution margin. Not a surprise, but what we would expect. Moving on from that, it's quite interesting to look at exhibitor churn rates and say, well, what is the industry standard, if we could say there is such a thing with so many diverse models in the industry, of churn rates. So here we're showing the range of churn, some events knocking down towards only 10% churn, others up into a very sorry picture closer to 80% churn. And we define what we would consider to be a healthy churn rate, and we put leading shows in that category. So when churn goes over 40%, we think we're leaving the healthy zone. We've given some examples. So the example here is based on one sector on the right-hand side with these colored blobs. This happens to be sort of industrial events. And we've put here some poor performing shows and some follower shows with some of the churn rates which came out against the industry benchmark. Again, that's just a salutary thinking for anyone running those shows or asking the question of, do we have a churn rate at this level for a good reason or for a bad reason? Having said that, margins will vary. So there's one leading show, very substantial show in the red blob with the churn at that level with a margin of 50%. And there's one of the follower shows in there with a contribution margin of 70%. So contribution margins don't necessarily follow directly. We have to slice the data specifically to find comparables. But overall, this gives us, I think, an indication of where churn rates are at and what we would consider to be relatively healthy on the exhibitor side. We then move on to contribution margin and looking at this really on a basis of per square meter uplift. We have here the average price per square meter measured by competitive position. So we've taken our leading shows and we've taken the following shows and we've looked at the revenue achieved per square meter. And what we can see here is the market leaders have overall about a 30% price advantage over the following events, which is a pretty healthy gap between leaders and followers, meaning the leader is able to exert its pricing power over the followers in the market. And I think pricing is becoming increasingly important within this mix of value which the industry needs to make sure it's going to give to its customers. We then had a different look at this, and we've measured price uplift against what we call, sorry for the jargon, KPC performance. So KPC stands for Key Purchase Criteria. So those are cases where we have asked exhibitors, how well is this exhibition faring against what you want it to do, visitor quality, so on and so on. And we have scores based on feedback from exhibitors. And we put those into two buckets where there was a high performance and where there was a medium to low performance. And so having established that a leading show has got pricing power of, say, 30%, what we find is that where we go to shows and we find the shows which have got the happy exhibitors, in inverted commas, and we ask the question, what is their pricing power over shows where the exhibitors are less happy, we find there is greater pricing power. So the pricing power uplift there is in the region of 40–45%. So yes, it's great to be a leader, but actually, it's a bit obvious now I'm saying it, isn't it? Having happy customers gives you greater pricing power. So I think that's a fundamental point of the source of pricing power, as I think increasingly we're asked to help people look at how they can price their exhibitions and how they can position the pricing correctly so exhibitors don't have a revolution and they're actually pricing against value. It is really that level of satisfaction which is very important. I'm just going to stay with this KPC analysis and just bring out a couple of things, and then we'll move on to another interesting part of the pricing power argument. Here we're showing across the database the results of this asking exhibitors what mattered to you and how satisfied were you. And we have the high-performing shows in red, showing the performance level which led to that pricing power of the happier exhibitors, and the green line, the medium and low-performing shows, we can see the gap across the board. And the number one thing that exhibitors are asking for is visitor quality. That's not necessarily new, but I think that's a message which the industry has had a habit of paying lip service to or not paying enough attention to. And for some time I've talked about work out why your visitors didn't sleep last night. This is really something which is now on the agenda for the industry, and we can't just say, oh, we'll fill a room up with a hall up with visitors and it will work out. I think getting closer to understanding visitor quality is a prerogative now for the industry. So I'm sure a lot of you will recall some of the things in our white paper, but here is a brutal summary, and I referenced this earlier, of what has been happening in the industry for a decade, which is that exhibitor value, which is a function of quality, number of visitors, and the time they spent at show. That is what the value we're giving to exhibitors is. So that value is the amount of time exhibitors can spend with quality visitors. That's what they are paying for. And as we've shown, that has been in decline for a decade, with the exception of visitor quality. But we can actually measure the time spent. The quality is more difficult to measure, and that's a massive challenge we're going to consider taking on. But in order to improve spending more time with quality visitors, the challenge for the industry is optimize marketing strategy. And you remember I pointed earlier to the range and spends on marketing, and talking about that adage of half of my advertising is wasted, I don't know which half. We can get more sophisticated about that now. Increasing visitor retention and increasing visitor time at the show is clear, making sure they're going to be meeting the right people, and obviously doing things beyond the trade show dates, but I'm not going to be focusing on that at the moment. So if we move on, we've looked at exhibitor churn, we've looked at the pricing power delivered through exhibitor satisfaction. What about, exhibitor churn and exhibitor satisfaction? Let us now look at the visitor angle and ask ourselves questions about visitor churn and visitor satisfaction, because that is actually the heart of value, because by delivering the right visitors, we're going to have that pricing power and be successful. So we have here visitor churn data, and we've put this into two categories. One is by named individual, and the other is by company. Obviously, named individual, we're going to have a higher churn rate than by company, but I think it's useful to measure both of those to see the pattern of attendance. And we can see, again, we highlight what we consider to be a healthy churn rate and an unhealthy churn rate in visitor numbers. On the right-hand side, as we move on to average visitor satisfaction score, what we find is we've got the high retention shows and low retention shows. Now, of course, there are going to be exceptions. There are certain types of show, for example, hosted buyer, where maybe we want to be alternating the buyers each year so we don't see the same people each year. So yes, there will be exceptions to this. But overall, we have seen a number of shows where we've been concerned at an unhealthy churn rate of visitors because they were not being given the value of the exhibition, or they weren't being shown actually how to get value from that event. So we think this is an increasingly important measure as a part of the attendee story and the attendee satisfaction story in the industry. So I think the conclusions which come out of what we've been talking about here today are that despite the struggle we have with the economic climate, we've retained a healthy growth outlook for the industry. Some of the growth forecasts are marked down a little bit, but fundamentally we're still looking at a growth story for the industry. That same story about emerging markets remains true. We've got some jockeying for position between which countries got the highest growth rate. We will always have that, but fundamentally the emerging market story remains the case. Although there's a lot of competition for deals and people getting into those markets, there's still headroom there. I think non-space revenue growth is something the industry has been working on and hasn't necessarily been highlighted to a great extent before, and is particularly important. And we can see that at 20% of the industry is a significant chunk of the industry and is one of the growth drivers. And I think the price point is something we wanted to bring out to say there was a watershed in pricing power industry-wide at the Great Recession. And that pricing power can now only be delivered with attendee value. And without a real focus on attendee value, it's going to be difficult to have long-term success in the industry. Now, of course, there are numerous other profit drivers which I've pointed to when we looked at the cost base slide, and so there's a different story for every event. But I'm just wanting to bring out some of the bigger ones. But my sincere hope is that this year is a turning point at which the industry will pay a lot more attention to visitors. It's actually easier to get visitor information now because with electronic feedback mechanisms, it is easier to gather data to understand who they are, what they want to do. And this is a turning point at which I think the industry needs to use those tools to make sure we're going to deliver the value to the visitors, which means that the exhibitors will continue to get what they want and we can price accordingly for them.